Hello guys, welcome back. This is FTS once again. I am not a financial advisor, neither do I give financial advice. This video is for educational purpose only. And as we know, past profits do not guarantee future result. The forex market is volatile. As you take your trades, apply risk management. Today's class is centered on the dollar index, right? The DXY, right? I've seen a lot of traders in the market. They don't even know anything about the dollar index. It's only a few expert traders that really pay attention to the dollar index. But today I'm going to expose us to the secret behind the dollar index, right? Yeah, I'm going to tell us everything you should know about the dollar index and why you should do analysis starting with the dollar index, right? So, and as you can know, I'm a fundamental analysis trader, right? Yeah, I use fundamental analysis to determine my market sentiment or market bias. Then I use technical analysis for entry. And one of the tools we use in analyzing the market is the dollar index, right? The DXY, right? So that is why I am doing this class, because most of us we don't really understand why DXY and why we use dollar index to analyze the currency market, right? So the dollar you see is the most traded currency in the world and the world reserve currency, and every transaction in the world, 90% of it is done using the dollar, right? So it's good to understand the dollar. So if you can understand the dollar very well, or the DSY, right, you will know how the major currency move and how to trade the forex market very well without, I see submitted traders, they just open chart in the morning. The next thing is, they go to Euro USD, they go to GP USD, they go to USJPY, they go to USCHF, they go to Aussie dollar, they go to Kiwi dollar, they start analyzing without even talking about what is the dollar itself. You understand? Right. So this class is here to, like, to answer that question, to tell you why you should analyze the market, use the dollar index, or from the fund, or as a tool, as a fundamental tool, right? So for me, I don't just see dollar index. I just like a technical tool to analyze the market, but as a fundamental tool, because if you can understand the dollar very well, you can really understand what is going on in the forex market, right? Um, the forex market is centered mainly on the United States economy, and mainly because the major currencies you see, they are paired with the dollar. They're called major currencies because they are paired with United States dollar. So as a trader, you should understand that you cannot do without a basic understanding or a background knowledge about the United States dollar. So let's jump in and see what the dollar index is, or what the dollar is, right? Yeah. Now, the dollar index is the basket of the six major currencies in the world weighted against the United States dollar. That means when you put the dollar itself side by side with the basket of the six major currencies in the world, and when you weigh them, it's called what? The dollar index. Now, at the time, when you have a scale like this, if you look at my chart, you see a scale like this. When you have a scale like this, the dollar against the basket of the six major currencies, right? If the dollar tilted high like that, that means the dollar is strong at that particular time. And if the basket of the six major currency, the word tilted to the lower side, means at that particular time, the dollar is strong. But if the reverse happens, if the dollar goes down and the basket of the major currency goes up, that means the dollar is weak at that particular time, and the basket of the six major currencies are strong. Now, what are the six major currencies? If you look at this uh, pie charts you see here, you see the six major currencies, right? From the strongest to the least, right? So the strongest is euro, which is what, 57.6%, right? So the euro is also strong in terms of the six major currencies, followed by the Japanese yen, right? So the Japanese yen is 13.6%, right? Followed by the GBP, right? So GBP itself is 11.9%, followed by the Canadian dollar 9.1%, followed by the Swedish krona, which is 4.2%, and the Swiss franc 3.6%. So these are the six strongest currency in the world, right? So when you put this currency, the basket of it, when I mean basket, putting all of them together. So when you put all of it together and you match it side by side with the dollar to tell you how strong United States dollar is, right? United States economy is, how strong United States dollar is. So you cannot just analyze the forex market, open your chart as a technical trader, and you just start analyzing Euro USD, analyzing GBP USD, analyzing USD card, analyzing AUD USD, and the major pairs without understanding what the dollar index is all about and the kind of and the role it plays, then its importance and the strategies of how to use the dollar index. So these are the things we likely want to discuss in this class, right? So I want us to pay close attention in case you don't even know anything about the dollar index. You have one or two to learn about the dollar index. Now, let's talk about the role the dollar index plays in the market. Number one, it said it serves as a benchmark, right? It is the benchmark strength against the trading partners, right? So it serves as a benchmark. It measures the strength of the United States dollar against the other major currencies. You understand that it's widely used by traders and institutions and even central banks, right? So, in every country in the world, they have dollar reserve, right? Every country they trade using dollar institutions. Most countries, in short, even in some African countries, they transact in dollars, and which is not good, right? That by doing that, you are undermining your country's currency. But some countries, some hotels around the world, because of the popularity of the dollar, they use it to do transaction, right? So it acts as a sentiment gauge for risk appetite. When I mean sentiment gauge, I'm talking about risk on and risk off, right? So there's global when the global economy is strong, right? Yeah, investors, they start selling the dollar because at that time they want to take risk. But when there is a global tension and all of that, they start buying the dollar because it has as a safe haven currency, right? So that is what I mean by sentimental. Okay, so the dollar itself is so strong. And when I'm talking about dollar here, I should be talking about the dollar index because the dollar index, what happens in the United States economy, it directly affect the strength or weakness of the dollar index, right? Now, why is the dollar index important? Pay attention. Number one, dollar is the world reserve currency. I've talked about that before, right? So every country in the world, they have, apart from gold, right, which is commodity. Some countries they have gold reserve. While some countries also have dollar reserve, right? They have dollar reserve and they use the dollar as a hedge, right? So use the dollar as a hedge. So every country's central bank they have a reserve of the United States dollar, right? Yeah. So number two, used by 90% of forex transactions globally. I've talked about it before. If you travel to the countries, because you use your own currency, you travel with your own currency. When you get to the country, you need to buy the dollars first, or you travel with the dollar. You cannot use the dollar to transact. You can sell the dollar to buy the local currency for that transaction. So you need dollar to transact around the world. So that is why the dollar index is also important. Or the dollar, United States dollar is important, right? Then it determines commodity price like oil price, gold price, and every currency that has to do with that is paired with the dollar, right? So you can see the United States dollar is so strong. As a trader, you cannot do without the understanding of what moves the United States dollar or what influences United States dollar. So or what influences the dollar index, which is what the DXY pairing the six the basket of the six world's strongest currency against the United States dollar, right? So what you imagine, so what am I trying to say is that the United States dollar is the equivalent of the basket of the world's six strongest currency. So you cannot just shove it aside when doing analysis. You must start with the dollar index in terms of understanding what you're trading in the market. Right now, how do you use the dollar index as a trader, right? How do you use the dollar index as a trader? So I want to go to let me go to the chart now to show us one or two. Now, this is let me put this off for this class, right? Now, this is my trading view, right? Yeah, you can access the dollar index from the trading view, right? Yeah. And though the dollar index have several variants depending on the broker you are using, right? So this is for FST for FSC, it's called dollar index basket. It's still the same thing, right? Yeah. If you look at this if you search from here, you will see uh USDS. Yeah, it's also from Pepperstone. It is called USDS, right? So if you have Pepperstone, if you get Pepperstone broker, you can see it this way. You can also see another variant as DXY. It's still the same, right? Yes, but for TVC uh broker. So you can access it like that, right? So these are the various variant of the dollar index, right? The various symbols you can use to identify the dollar index, right? So this is the dollar index, and when you do analysis as a trader, you normally start with the dollar index. As for me, this is what I normally start with when I'm doing my weekly market review or monthly daily market reviews in my trading community. I normally start with the dollar index, and because I know what if you can control, if you can analyze the dollar index very well, you have succeeded in analyzing 80% or 70% of the market you want to trade for that particular period of time, right? So this is the dollar index, right? So the first thing we should discuss here is the first uh the first use of dollar index. Number one is for what? Confirm direction. It says if the dollar index is bullish, right? Pairs like Euro USD, GBP USD, Aussie USD usually falls. What does that mean? Right? I will take us there and I'll talk about it. Then number two, it says is identified divergence, right? Now it says sometimes dollar rises, but not all USD pair follows, right? So we're trying to talk about divergence, right? Sometimes you see the dollar index will rise, but not all the pairs will rise because we talk about divergence. We're talking about some pairs that have dollar as the base currency and dollar that as the quote currency, right? And it also confirm. It also talk about this point also here. This point that I just mentioned now. Uh it's also in line with this you know bullishness and bearishness of the pair, right? Yeah, so I think when after this I'll go to the trading view to talk about all of this, right? Then number three, it said a trend confirmation, right? So you use dollar index to confirm the trend of a particular pair, right? Especially the major pairs. So for me, what I do is that once I can analyze the trend of the market, right? Using fundamental analysis, especially the dollar index. If the dollar is strong, that should be the trend of the market for me, right? That means for the major pairs, if I'm buying the dollar, if the dollar is strong, that means I should be buying the dollar. That means pairs that have dollar as the base pair, like USD JPY, USD CAD, USD CHF should be bullish at that particular time. The trend I'm talking about can be short term, can be medium term, or can be long term, depending on the one I'm trading at that particular time. So, like I've always told my people, students in my trade community, what to do is that we don't trade technical trend, we trade fundamental trend based on the fundamental bias of that particular at that particular time, especially of the dollar, right? So if we're analyzing the market and we saw that the dollar is strong at that particular period of time, that means we'll start buying the dollar, right? What I mean buying the dollar, I mean we're buying pairs like USD CAD, USD JPY, USD CHF, USD ZAR, or USD Mexican peso at that particular time. But if the dollar is weak, you understand, then we'll buy Euro USD, GBP USD, Aussie USD, NZD USD, because at that particular time the dollar is expected to fall. Because if you look at them, it's just like we are trading against the basket of the six major currency and the dollar, right? So then institutional level, right? So institution watches round numbers like 100, 105, and 110 on the DXY, right? So let's head back. So let's head back to trading view for also. properly talk about this. So number one point here we'll talk about is going to be the confirmation of the direction of the market, right? Confirmation of the direction of the market. So one thing that I normally do is that I use, you know, let's take for instance, the job data, the weekly market reviews I did this week. We pointed out that the dollar is bearish, right? The dollar is bearish. When I mean dollar is bearish, I mean pairs like GBP USD should buy, Euro USD should buy, right? Aussie USD should buy, NZD USD should buy. Then the pairs that have dollar as the base currency, like USD CAD, USD CHF, right? Then USD JPY should sell. A bearish dollar means the dollar is going down from the dollar index perspective. You understand? The dollar is weak at this particular time. And why is the dollar weak? Because of the job data and the job data that came out this week and the job data that came out this week came out last week Friday was that means for the NFP was 22,000 against the market expectation of 75,000 uh job job data, right? So because of that, and apart from that, the United States has priced in for rate cut, right? So on the 17th of this month, like 9 days from today, right, the rate cut will likely happen, and which will lead toward the devaluation of the United States dollar. So because of that, investors have priced in for rate cut, right? So the dollar is bound to fall. So that's why we have what a bearish dollar, right? So the dollar is going down because of what rate cut expectation and the job data that came out, right? So there is no way you can be buying dollar at this particular time, right? So the trend of the dollar at this particular time, it's what the dollar should be bearish, and they're expected to cut rate twice or three times this year, as the case may be. And the CPI that will come out that will happen on Thursday will likely also determine if the rate cut will be 50 basis points in this September, or it will be 25 as the case may be. You understand? So the dollar has confirmed the direction of the market at this particular time because what? The job data that came out, right? Yeah, the job data that came out has already told us that, okay, the dollar will likely be bearish. You understand? So because of that, I will focus more on the pairs that have the dollar. Then I will start selling, especially the major pairs that the dollar that has dollar at the base. That dollar is based, right? When I mean base, USD, Euro, USD JPY, USD CHF, and USD CAD. So the direction of the dollar should be bearish because I've already analyze the dollar at that particular time. Then number two, I talked about what? Number 2 point is divergence. When I mean divergence, I mean, when you pair the dollar side by side with other pairs, then when the dollar is going up, others should be coming down. I would like to show us what I mean right now. So let me just take us to the 4 hours time frame and show us the divergence, right? If you look at here at this particular time, the dollar is coming down. Then now let me pair the US dollar with let me pay with Euro USD. Euro USD. Right? Let me pay it with the Euro USD, and yeah, well, take a look at this. Take a look at this. You guys understand what divergence means, right? Divergence means when two things are going in different direction. Now, this chart you'll see here, this is the dollar. Why this other one that has this red line is Euro, is Euro USD. This is the dollar. This is Euro USD. That means if the dollar is coming down, right? If the dollar is going down, right? We expect the Euro USD to go up. That means they are going in different direction. So if the dollar is falling, there is no way you should buy the Euro USD. You should sell the Euro USD. That means if dollar is going down, Euro USD should be bullish. That is what it means. You understand, right? If the dollar is going down, as like we've seen already, right? We saw that the dollar is pointing towards the downside. Then what happened? We expect Euro USD, GBP USD should be bullish at this particular time, right? So that is what I'm trying to say. I just use Euro USD as an instant, right? So let me also use let me use GBP USD. So in terms of divergence, they are what? They are divergent, right? That means they go in different direction. Now look at GBP USD as well, right? Look at GBP USD as well. So this pink one is GBP USD. This red one is Euro USD. Why the dollar is the one on the chart, right? Now let me add another one again. Let me add let me add let me add gold. Let me add gold. Right? Let me add gold so you understand SAUSD. SAUUSD. Right? Let me add gold. Now look at this. Now I've added three different currency pairs, right? I've added three different currency pairs. I added GPUSD, which is look at the colors here. Now look at the color interpretation. Gold is this one. So this is gold. The pink is GPUSD, while the red is Euro USD against the dollar. You can see that all of them are tilted to the upside while the dollar is going down. So this is what's called divergence. So whenever the dollar is going down, we expect GBP USD, Euro USD, gold, Aussie USD, Kiwi USD to go up because the dollar is weak. So we expect them to be strong because that's called what divergence. So they don't go in one direction, they go in different directions. So this is the divergence I was trying to talk about, right? So so guys, you now understand what the divergence is all about, right? So the dollar index is like what you use to scale the market in terms of what? Divergence, right? So one of the points I talked about again on how to use the dollar is, the trend confirmation. Now, like I said, if you understand the market very well, right, you will not just jump to Euro US and start trading, right? So, like what I do is that I try to analyze the market fundamentally I try to analyze the market using fundamental analysis, right? So I normally start with the dollar index, right? So if I can understand what happens in the United States economy in terms of the dollar index, right? And I match it with the dollar index, I tell you the trend of the trend is already analyzed already. So I don't use technical trend, right? So technically you see that the dollar is going down. And what is the rationale behind it? This dollar started going down the moment Trump was sworn in on the 23rd of January because of his inflationary policies, right? And whenever you talk about rate cut and low and high and lower inflation, it's against United States dollar, right? So policies, Trump was trying to fire Powell because of rate cut. He had been signaling for the rate cut for the past 3 to 4 months, and Powell doesn't want to, succumb to Trump without proper data to back up the rate cut. Finally, he got data to back up the rate cut, so he made a call for rate cut from the last from the last uh, inflation FOMC market, right? So he called for rate cut, so and this month they will likely rate cut will likely what happen, right? So they'll likely cut rate this month, and for the first time this year, United States will likely cut rate less. So because of that, so the trend we're seeing here is the fundamental trend, and I told us the reason why the market is going down, right? Yeah, so investors are pricing that the dollar will crash because of President Trump, and you know fundamental reasons that have happened. Many of them have happened. We saw that the dollar is crashing, and the dollar we see crash to the downside because of what the devaluation of the United States dollar due to what rate cut, right? So, and as a trader, the as the dollar is going down, it has already determined the trend of the market, right? It has determined the trend of the major pairs, right? You can see gold has created a new all-time high of 3,600, and it's still going on, right? 3,636 and 7. So that is the current price of gold at this moment, right? So, and as a fundamental trader, you should know, right, that you should not sell gold at this particular time. The only thing you can sell gold is when gold starts to do a pullback, but we are not waiting to we are not going to trade a sell for gold. We are waiting what to buy gold, right? So all the analysis you are seeing here on the chart are what analysis to buy gold, but gold is the volatility is strong, the momentum is strong at this moment. That's why we cannot even buy gold at this moment, right? So sorry, that's why we cannot even sell gold at this moment, right? So that is how. So these are some of the ways we use, right, the dollar index, right? So to determine the trend, to determine the direction of the market, and also as trend as divergence, and also as confirmation of the major pairs and all of that. So when you can analyze the dollar index very well, if you use dollar index like this, I tell you, you have succeeded in analyzing the markets to a greater extent. Now, strategies in trading the dollar index. Number one, strategy in trading the dollar index. Um, I call it dollar index, and it's what? Correlation. When I mean correlation, is that how they move. You understand, right? I've showed us from the chart that gold is directly opposite of dollar. That means when gold is buying, dollar should sell. You understand? When dollar is buying, gold should sell. There's only one scenario when dollar and gold move in the same direction. That is during a risk of market sentiment, right? Or during geopolitics, right? Or like example, during the COVID-19, because both of them as safe haven currency and safe haven commodity. So if investors are to safeguard their funds, they buy into gold or they buy into the United States dollar, right? Yeah, that's the only time you can see sometimes, or sometimes you see manipulations in the market. You see gold is rallying, the dollar is rallying. So whenever you see it and there is no risk of market sentiment, or there's no geopolitical tension or global crisis, just know that there is manipulation at that particular time, and you have to be what? You have to be careful. Now you can see that gold is strongly inversely correlated to the dollar. Inversely correlation means they go in different directions. It means if gold is going up, the dollar should what? Come down. That means if you can analyze the dollar as a bullish bias, as a bearish bias, you should be buying gold at a particular time. You understand, right? That means gold is negatively correlated to the dollar, or you call it inverse correlation. That is the right term for it. Or sometimes I say negatively correlated. That means they go in different direction. As he said it here, he said whenever dollar is up, gold should go down. Whenever gold is up, dollar should come down. Now, another strategy to trade it is the test of correlation is the stock market, right? Yeah, when I mean the stock market, I'm talking about the United States stocks, right? The United States companies that went public. You understand, right? So we're talking about the Nasdaq 100. We talk about the first 100 best companies in the United States. You started the first 30 companies, then S&P 500, the first 500 companies that are in the stock market, right? Yeah. Now, there's one about the stock market and and the dollar index, right? So dollar index and the stock market, they have inverse correlation too. You might be surprised. How come we're talking about the stock market and it doesn't go in the same direction with the dollar? That's what you should know, right? So whenever S&P is bullish, the dollar should be bearish. So if you are trading Nasdaq 100, right? If you can analyze the dollar index very well. Now let's go back to the chart and see how you will see it yourself, right? Because I love being practical here, right? Now let's go back to the chart. So this is the dollar index, right? Now let me add S&P. Look at S&P 500 here, right? This is S&P 500, right? Let me add it. You will see it. Now look at it. Let me go to D1. Sorry. Now look at it. Look at S&P 500 and look at the dollar index. S&P 500 is bullish, has been bullish. That means the United States stock market has been doing well. That's what it is. Why the dollar index is what? Bearish. So whenever stock market will crash, the dollar index will be bullish. That means we have a stronger dollar. Why? Because dollar is acting as what? A safe haven at that particular time. Because during geopolitical crisis or during a global tension, stock market normally crashes because people will really sell up their stock to buy into safe haven. But when there is due risk on market sentiment, we expect the stock market to rally while dollar should fall. That's one of the reasons why you should understand what happens in the stock market, right? Yeah, and even though you use US tech, you use S&P 500. Okay, let me say let me put in Nasdaq, right? Nasdaq 100. Okay, look at Nasdaq. Let me add US tech on Nasdaq 100 to it. You see. You can see, right? Nasdaq 100 and S&P 500, they go in the same direction, while the dollar goes different direction. So if you are a trader that trades Nasdaq 100 or S&P 500, right? Just analyze the dollar index very well. I tell you, you've got your market bias because they go in different direction. So you can see the importance of dollar index, right? You cannot just underscore the dollar index. Now, the bond market. The bond market is positively correlated to the dollar index, right? So I will explain what the bond market is all about very soon, right? But let me just tell us about the United States bond market. Now, the bond market is opposite of the stock market. Now, when there is geopolitical crisis, people buy into bond market and they sell off their stock, right? Now, the bond market is the world's safest place to invest your money because the risk there is like zero, is like 1%. No risk in the bond market at all. You should not risk because whenever you invest in the bond markets, it's like you are saving your money. That's how it is. Let me just give us a little tip, a little explanation of the bond market. Now, if a particular country's government wants to carry out project, but they don't have funds to carry out a particular project, maybe they want to carry out let's say the United States economy wants to build a bullet train station that can run within the country in less than 20 to 30 minutes, a bullet train project, but they don't have funds. What they do is that they solicit for public funds. Then that public fund is called what? The bond market. So they say, okay, they say the public should come and give their funds to do that project. And when they do that, you borrow the government money. When you borrow the government money, you get interest in borrowing the government money. That interest is called what? Uh the bond. You understand? So you buy the government bond, you buy into the government bond, then they give you interest, right? Yeah, they pay you the interest. And you can fix the government bond can last from 2 years to 10 years or 30 years, depending on the kind of the number of years you are fixing that money. And if you fix that money for 2 years, there's a kind of percentage. The percentage is lower depending on the amount of years, and it's higher based on the number of years. If it's 10 years, it's called the United States 10 years bond, 10 years yield. If it's 2 years, it's called 2 years yield, right? So the United States dollar and the bond market, they go side by side. You understand, right? They say where the yield is up, the dollar is up. True. Then where the yield is low, the dollar also low. Now that the dollar index is the dollar is bearish, right? We should expect the 10 years bond yield to be what? To be bearish as well. I won't say all of this without showing us from the chart. So you should understand the importance of all of this. So first of all, let me take this out, right? Now let me put in the look at it 10 years. This is 10 years government bond yield, right? Let me put it using as you can see. You can see, right? Look at both of them are pointing downwards. You can see, right? Now that the bond market is going down, the United States dollar is also going down because of the bond market. So as at this time, it's not advisable to buy bonds, right? Buy bonds when there is global tension or during risk off market settlement. But during risk on, you buy the stock market. You understand, right? So when the bond market is low, the United States dollar is not doing good at that particular time. right? So you can see that the bond market and the United States dollar, they are positively correlated. So this is how, these are strategies to use in trading United States dollar, right? The DXY or the United States dollar. Now, what influences the dollar index? What causes the strength or weakness of the dollar index? Now, since I've been talking about the strategies, right? Now, I want to talk about what causes the strength or weakness of the dollar index. So I will draw the curtain of the class here. So I will continue the part two of this class from this point in the next video. All right. Uh, 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 Stay tuned and wait the next class. If you have not subscribed or like my channel, kindly subscribe, like, and comment my comment section. If you have any question, let me know. All right, take care and have a lovely day. Thank you.